Thank you. My theme for today is it looks like we're in a global slowdown with not only the U.S. economy is slowing, but Europe is slowing rather dramatically, and China is slowing rather dramatically, and Japan is still pretty weak. So the whole world is sort of caught up into something, which is really the mirror image of 6 to 18 months ago when we were in a global synchronized expansion, where the United States was strong, Europe was strong, China was strong, and now it seems that we're all going in reverse. So my themes are for several conferences we've been saying we've been in a 3-2-1 economy, 3% in 18, 2% in 19, 1% in 2020. The 18 forecast came in right. We got the 3%, so 1 out of 3 so far. We're a little weaker than we were last time for 2019, about the same for 2020. To put our forecast into context is we are lower than consensus by a bit for 2019. We're lower by a lot for 2020. So this is an out of consensus, especially for 2020. This is an out of consensus. Forecast. We have the unemployment rate dropping to about 3.6, then rising to 4. Inflation we have on the core basis and also ultimately in headline will be over 2%. The Fed policy is uncertain. We have a rate hike that should be 2019 instead of 2018, and then we have 2 or 3 cuts in 2020 on that, and it's really touch and go whether we get a rate hike or not this year. Our sense is by the second quarter is the economy will be at least temporarily looking a little bit better. The main strength in the economy has been intellectual property, which we're going to talk about later. And the 2 drivers for intellectual property has been cloud computing, where corporations are moving all their software to the cloud, and the new Hollywood, which we'll call video streaming, Netflix, Hulu, Amazon, and what have you, and that's also driving intellectual property. And the other thing is we're looking at is we'll have $1 trillion budget deficits and $1 trillion trade deficits for as far as the eye could see. So this is our forecast for GDP. And if you'll notice, we dipped down here to 1.7 in the current quarter. This is the one place where we're more optimistic than consensus, because consensus right now, if you look at all the surveys, what people are saying, people are talking about 0.5%, less than 1% for the first quarter. We're at 1.7, so if that happens, we'll get a stronger second quarter. We're at 2.4 for the second quarter. So our sense is if you average the 2, the 1.7, and the 2.4, that's how we'll probably come out around 2% average. But consensus has first quarter much weaker than what we have it. Then we sort of meander along at 2, go down to about under 1% at the end of 2020, and then coming back. So this basically says there's a chance of a recession risk, the way we're looking at the world, in late 2020. We're not forecasting a recession, but whenever the economy gets below 1%, any little thing could tip the economy over into a recession. So we don't see a recession in 2019. Remember last quarter we were here, the stock market was falling out of bed, and the stock market was seeming to tell us the recession was going to happen next week. And we said the stock market predicted 9 out of the past 5 recessions, and it didn't happen. So if there is a recession out there, it's not in 19, it's somewhere in the end of 20. Okay, we have employment growth leveling off and slowing, and you see here we have a little downturn in employment at the end of 2020, and then picking up in 2021. So the thing is that's going to sort of look like a recession when the employment gains are going to begin to slow. And the thing is we had this 20,000 gain for the month of February. It's not going to be 20,000 going forward, but the thing is we're not going to see the 200,000 a month we've been used to. We're going to go down to 150, then 100, then 75, and then maybe for a couple of quarters it may go negative by a little bit. And here's the unemployment rate. The unemployment rate bottoms at 3.6, goes to 4.2, and then begins to fall again. Now the thing is Ed will talk about this, or will mention, whenever the unemployment rate has ever moved up by 0.5 point, it keeps going. So the thing is this is an exception to the general rule. It's going to be up 0.6%. Normally when that happens, we go into recession and the unemployment keeps going up to it'll go from 3.5 to 6.5. We don't have that. We have the economy resuming 2% growth at the end of the beginning of 2021. So it's a mild increase to 4.2. But the thing is by a lot of estimates, 4.2, 4.1 is viewed as full employment. So we're going from a below full, a very, very strong employment economy to something just like above full employment to just to a full employment economy. So this is 4.2. And if you think back 3 or 4 years ago, 4.2 would be a great number anyway. So that's why we don't think we'll head into recession. The other thing is globally, growth is slowing. Now this came from the IMF. The data here came from the IMF in January. And when we were writing up this report in mid-February, we were looking at a whole bunch of contemporaneous data saying there's going to be downward revisions to the data. And here, if you take a look at Eurozone, here it's showing just from 1.8 to 1.6 year over year, no big deal. But the thing is the latest numbers coming out of the Eurozone is now 1.2. And that's a huge drop when you do year over year. So Europe is practically in recession. Italy, they have it 0.6 in 2019. And Italy probably will have a minus sign in front of their economy in 2019. And Germany is going to be pretty close to recession also. China, they had going from 6.6 to 6.2. The official Chinese forecast was lowered from 6.5 now down to 6 to 6.5. And in China, they make up the numbers. So whatever they forecast, that's the number they're going to get. But the other thing is there's been a recent econometric study on China basically saying their growth historically has been overstated by 1.7% a year anyway. So when people hear the 6-7% numbers for China, the real number is probably 5 and not 6 or 6 or 7. So the thing is we have slowing in Japan, we'll have slowing in the UK, and the UK, this is the boat is going down after they voted in Parliament. And the special place in hell that was a direct quote from the head of the EU, Mr. Tusk of Poland, and that's Boris Johnson there leading the UK economy right, straight down into the fires into the fires of hell. And who knows what that will bring, because that could create a banking crisis, it could ripple back to us, and your UK could be out of the EU with no Brexit, no plan, no nothing on the end of this month. Right now, the stock market doesn't seem to care right now, but maybe the EU will, and the UK will work it out. But there are serious issues that could go back to the United States. And here we have is Donald Trump and Chairman Xi, having the big face-off, having the big face-off over trade. I don't know who's Clint Eastwood in this chart, so you have to figure out who's Clint Eastwood. But the thing is when the North Korea summit broke up in Hanoi, and Trump went back to Washington and Kim Jong-un went back to North Korea, is people thought there was a deal, and all of a sudden there wasn't a deal. And the thing is the Chinese understand what Trump's history in New York real estate was. And anybody, and I have met Donald Trump, I met him on one occasion in real estate in New York, and whenever Donald Trump showed up at a closing, whether he was buying or whether he was selling, at the last minute, he'd bring up new conditions. Always, inevitably. He'd always wanted to get something a little extra. Everybody's ready to close. And now say, we're not going to close unless you do this for me, unless you do that for me. And the thing is what Xi is. Xi doesn't want to fly to Mar-a-Lago, where there was supposed to be a summit meeting to sign the trade deal, because Trump says, we'll have most of it done, but we'll do the final negotiation in Mar-a-Lago, and the Chinese aren't going to play that game. So if they announce a summit meeting, the deal will have to be basically done, and there'll be no changes at the last minute. Because Trump's history in New York real estate, and he's not the only one in New York real estate who does this, his history is at the closing, he asks for additional conditions. And I think, and that's why it's very difficult. It's very difficult to negotiate with him. That's his art of the deal. All right. Now the other thing going on is we thought the Europeans were going to start to normalize rates, but I think 9 basis points for 10-year money in Germany is far from normal. minus 60 basis points for 2-year money in Germany is sort of far from normal. So that's sort of going to be maintained, the lid, the ceiling, that will be the ceiling on U.S. interest rates. So it's going to be very hard for us to see U.S. rates going much over 3%. We used to think the 10-year would go to 4%, but we don't think that will happen now because Europe is not normalizing. So for our 10-year to go to 4%, we're going to need the German rates, which are now 9 basis points plus or minus, would have to go over 1%. We don't see that happen, and the 2-year shouldn't be negative, so minus 60 basis points. And if you look at the chart there, the only country which has a higher 10-year rate than the United States 10-year out is Italy, and that's only by a little bit, at 287 there. And in a normal world, the Italian 10-year would be 6 or 7% right now. It wouldn't be 2.87%. All right, this is our rate forecast. The blue line's Fed funds. We have one hike, and the reason why we have a hike is that we think the Fed's economic forecast is stronger than our economic forecast. There'll be more inflation than what they think is going to happen. So we have one hike, but that's like 50-50, and then we have rate cuts in 2020 as the economy begins to slow. We have the 10-year peaking at 3.25 or so, and then dropping to 2.5. Here's the Fed balance sheet. It started out, it peaked at $4.5 trillion. It's under $4 trillion right now. The stock market had a primal scream in the fourth quarter, says, don't shrink the balance sheet, don't shrink the balance sheet. The Fed heard the primal scream, so instead of taking the balance sheet down to $3 trillion or under $3 trillion over a 2-year period, it looks like they're going to stop at $3.5 trillion, and it'll end this year, because there was market concerns about lack of liquidity in several financial markets. So that continues until the end of this year and then stops. The Treasury yield curve, the two things to notice about it is we have a partial inversion. It's a little bit more inverted today than on mid-February when I did this chart. And an inverted curve means this is 1 month money going out to 30-year money on the horizontal axis. So right now the yield on 5-year money is lower than the yield on 1-year money right now. That's called an inverted curve. Ed's going to talk about that when people worry about an inverted curve, they either talk about the 2-year money to the 10-year money, that's positive, or they talk about the 90-day bill to the 10-year, and that's still positive. We don't think that will invert over time. The other thing to notice is the currently, in February 18 and February 17, one thing that's sort of immutable there, 30-year money stays at 3%. With all the movement in interest rates, the 30-year really hasn't moved. It's 3%. And what that says is the market thinks the long-run outlook for inflation is about 2% a year for inflation and 1% real for the 30-year bond. So the 30-year bond hasn't really moved over the past 3 years. All right, we have compensation. We think it'll go to 4%. And our forecast turned out to be right, but actually before the fact, because for the third quarter and the fourth quarter, this data was revised up, and it's already at 3%. So so our big pop that's showing here in the first quarter already happened because the data got revised on Friday, and we didn't update the chart for that. So it looked, and year over year, non-supervisory wages are up over 3% right now. So we think there's wage inflation in the system. Next is we have inflation going modestly higher. The purple line is headline, the dotted line is core, and we'll basically be around 2.5% for the next couple of years. It won't be below. And part of that is we've seen the bottom, in our view, oil prices. And our sense is, when I was here last time, I said when oil was $45 a barrel, I said I spoke to my oil gurus, and I had my 2 oil gurus. They told me, I asked them, what's the long-run equilibrium price for domestic West Texas intermediate oil? And they told me $60. When oil was $70 a barrel, $75 a barrel, they told me $60. When oil was $45 a barrel, they told me $60. So our forecast is plus or minus. Oil stays at plus or minus $60 for the forecast period. So the recent drop in inflation due to lower oil prices, which translates to lower gasoline prices, basically that's behind us right now, and we're going to be stable around 60. Today oil is around $58, so Close enough. Okay, the other thing that's been booming is real investment in intellectual property. That was a 13% surge in the fourth quarter, and that's cloud computing and filmed entertainment and corporate R&D. We think a lot of that surge had to do with getting the money spent to get tax deductions in 2018. And that'll drop off to about 4%, still growing much faster than the economy as a whole. Housing, we have flattish until 2021, rising a little bit near term in response to lower rates, weakening in 2020. And housing starts is, you can't really tell it from this chart, but the long run underlying demographic demand for housing is 1.5 million, around 1.4 million to 1.5 million units a year. We haven't gotten there for over a decade. We don't get to over 1.4 million until the end of 2021. So our sense is we've been underbuilding. Our sense is we'll catch up to underlying demographic demand somewhere in 2021 at 1.4 million. But in the meantime, we're going to be locked into 1 million, high 1.2 million, low 1.3 million. Here's the federal deficit. And if we ran it out to 2029, it would be over $1 trillion a year forever. And part of what's been driving the economy and part of the deficit is that we had this big surge in defense spending, up 3% in 3.5% in 18, 4+% in 19. That goes to zero. So one of the reasons why we have the economy slowing in 2019 and in 20 is defense spending, which has been a big source of growth. The 4% essentially goes to zero in 2020 and 2021. And here's with all the tariffs we're imposing, thinking it would help our trade deficit, basically it just continues to increase, and the real trade deficit is over $1 trillion and continues to rise. And in a sense, is the administration is financing the budget deficit with the trade deficits, because the flip side of the trade deficit is a capital inflow, and it's the capital inflow that funds the budget deficit. So that's going to be over $1 trillion and continue over $1 trillion for the next several years. Tariffs or no tariffs, if we solve the problem with China, all it means the deficit will move to India, will move to Vietnam, will move to Bangladesh, because the thing is if we're consuming more than we're producing, which is what we're doing, we have to have a trade deficit. In order to get that, we have to bring in imports from someplace, and if it's not China, it's going to be someplace else. So our forecast is we're in a global slowdown. There's recession risk in late 20. Global economy is weak, especially Europe. 2020 will have a weaker labor market. The Fed policy is uncertain. Maybe one rate hike this year, then 2 or 3 cuts in 2020. Trade and budget deficits stay high. And the growth, we have a growth recovery in 21. And part of the thing that's going to drive the recovery in 21 is we'll finally see better days for housing construction. So thank you very much.